2023 off to a lousy start for stock pickers. Most actively managed mutual funds took a hit in the first quarter after bank failures and tech reversals, and this is according to Bank of America. So where does this leave investors? Here to discuss the cautious landscape in the market is Tastytrade CEO Scott Sheridan. Scott, thank you for joining us today. And just get your big picture overview of what we've seen in the markets this year and your opinion of where you think we're going here.
Yeah, good morning. Thanks for having me. So there's not much here that I'm going to say is a big surprise. I think we've been in a range we're topping, except for at these levels, I'm just a bit cautious. It's a handful of stocks that I'm looking at that, to me, say more potential for the downside than the upside. But I want to preface this with saying nobody knows anything. So when you hear the quote unquote experts say, be careful of inflation or recession or interest rates, I take that with a grain of salt.
I think, we've all learned from a lot, though, right, as well. And so even if we're kind of trying to look to what's taken place to at least give us some type of inclination as to where investors may place more weighting in their portfolio or where we may even see some shifts in that portfolio. As of right now, in the early activity over the course of this year, one of our guests earlier was bringing up that, this may not be the type of recovery that we thought was in the tape or we thought was at play, but more so just a bounce. What's your perspective there?
So I think we've had, unfortunately, and I say that very seriously, we had a 14-year period where nothing mattered. We just went up every single day. And I think what we're now seeing is we're coming back to reality. And this is what markets are supposed to do. You're supposed to have chop. I know that most retail just wants straight upside because it's great. Most retail is just long. So if you're just long, you want your stocks to go up. What we have seen for sure is a rotation on the retail side away from individual names because there is too much chop right now, and moving more towards broad-based like the S&P, so the SPY, for example. What I think is going to happen is that trend is going to remain the same for some period of time until we do get a base. And I don't know if we're making a base right now or if we're going to be heading significantly lower. My feeling is if we were to drop another, 500-600 points in the S&Ps, that would not alarm me whatsoever. Overall, the market is going to go higher. The question is going to be, is it next week, next year, 5 years from now? So for me, what I think the bigger concern is that there is a large percentage of retail traders, retail customers, who have never really seen a massive down move, which we've had a significant down move over the last year plus. Interest rates have definitely caused, slowdown in trading and a pullback in the markets. As you just said, VC funding is off dramatically. I think you said 56% year over year. And I just read this morning that bond issuance is down at its lowest levels in the last decade. That's telling you that there's concern out there, which I don't think is overall is good for the stock market. We want all the wheels greased and everything running smoothly. That's not happening right now. There is uncertainty and volatility. The VIX is telling you, the VIX is telling you hanging in the 20, 21, 22% level. It's a big number for the VIX. That's historically over average. And, I think for me, this is going to continue for for the foreseeable future. I'd say at least for the rest of this year, and we'll see if it goes into 24.
Scott, are the retail traders sticking with it, though? And I guess that's my question to you, because you've been in the brokerage business for a long time. A parallel that I've been looking at more closely is the 2000 to 2002, arguably 2003 bear market in stocks that lasted, well, let's see, we're about a year and a half into this one. That lasted twice that, or at least that. And in that case, I remember 2004, 2005, traders had largely abandoned risk markets and trading had become quite boring at that time. What's the risk that traders who haven't experienced this type of drawdown or get worn out and just leave the game altogether?
Zero. Retail traders are here to stay, and I think it's amazing. I think it's great. The access to markets is significantly different for retail than it was what the period you're talking about, and I traded in that period. It was a very different environment. So you have retail as a much larger percentage of the options market, stock market as well, but the options market for sure. So if you look at OCC volumes, you look at what the percentage that retail is putting up on a daily basis, that's not going to change. The overall market is slower. for sure. You're seeing volumes at the OCC. We were having 50 plus million days. Now they're 30s and 40 million. So there's a pullback, but that's okay. It doesn't concern me at all. I think retail is here to stay. And I think it's great because retail should have the opportunity to be involved in the markets and have control of their financial future and their financial freedom.
Do you believe that with the surge of retail traders that we've seen over the past 2-3 years overall, do you think that that's focused now in this environment more on trying to squeeze some of the shorts, or is it more focused on names that they personally feel some annexation to, that they know the businesses of, that they themselves are purchasers of and believers in the management team?
I hope the latter. What we saw with the former, with the squeeze, with the meme craze, I believe it was once in a lifetime. It was amazing. And it really was something. I think it was a 6 standard deviation move, something you're just not going to see again. So I hope that as people participate in this, they have a reason. So I'm not as big, and I think if you want to invest in something that because you use the product, that's great. But I also think that retail, there's so much education out there that's available to retail, really good education. And retail has the opportunity to get involved in a way and at a level they just haven't been able to in the past. So if people want to take this seriously, which I think most do, and unfortunately you hear stories, and the stories are the ones that make the press, and people go, it's bad, retail shouldn't be doing this. Completely disagree. There's going to be issues, in any situation. But in this case, I think if retail wants to continue to be involved, which I think they will, they're going to become smarter, better, more sophisticated. And I don't believe that there has to be a us versus them, meaning retail versus Wall Street. I don't think that has to be at all. I think both sides can live and play very nicely together.
Well, retail certainly likes to talk their book and talk their portfolio a little bit, well, almost synonymously, like some of the larger institutions as well. Scott Sheridan, CEO of Tastytrade Brokerage. Thanks so much for taking the time here with us today.